The broadcast is now starting. All attendees are in listen-only mode.
How many people?
Good evening, everyone. We will be joined in a few minutes by all the speakers, so kindly be with us. We shall begin shortly. Good evening, everyone, and thank you for joining us for today's webinar on analysis of the Union Budget 2019. The newly appointed Finance Minister presented the Union Budget 2019 earlier today. With the backdrop of mounting public expectations, the Minister made some relevant and specific announcements. In keeping with these announcements, we have organized a post-budget webinar for you, where our speakers will share their analysis with respect to direct and indirect tax proposals. Joining the discussion today are Rebecca Pinto and Nishit Parikh. Rebecca is a senior manager in direct taxation and Nishit is a practicing chartered accountant. Rebecca has diverse work experience concerning Indian GST, Indian customs and UAE VAT legislation, while Nishit has extensive experience in income tax, international tax, treaty provisions and FEMA. Before we begin, kindly note that all our listeners are in listen mode only. If you have any questions, please put them in the chat box on the right-hand side of your screen, and we will address your queries at the end of the webinar. We are happy to host today's webinar for all our listeners. Without any further delay, we shall start the webinar. Over to you, Rebecca and Nishit.
Good evening, everyone. I am Nishit Parikh, and I would be taking you through the direct tax amendments in the budget, and my colleague Rebecca would take you through the indirect tax amendments in the budget. So before getting into the budget, some of the key highlights which the finance minister laid out in the budget were, she once again emphasized that India is all set to become a $3 trillion economy. Currently, we are the sixth largest economy in the world. She also mentioned that the tax collection in the Modi government regime has been improving, and it has increased up to 78% to 11.37 lakh crores from financial year 13-14. They have constantly focused on reducing the NPAs for the banks, and also they mentioned even under a global environment, the FDI flows in India has constantly been increasing. Year to date from last year, we have an increase of 6% in the FDI investment, and post the e-assessment, now they are working towards going to a faceless assessment, whereby the taxpayer would be interacting with one unit which they would set up, and there would not be aware of the name of the tax officer who is dealing with the case. This is mainly done to discourage any corruption which may happen between the taxpayers and the tax authorities. So this is a welcome move which the government would look at implementing in this budget. Now moving on, one of the most controversial amendment or one of the most harsh amendment which was introduced was taxing the super rich. The government has proposed to increase the surcharge for super rich from 15% to 20% for taxpayers who are earning income between INR 20 million to INR 50 million, and from 15% to 37% for taxpayers who are earning income in excess of INR 5 million. So this result in increasing the tax rate for the last two category of the people, that is a income between INR 20 million and 50 million, would be increased to 39% effective tax rate, and for taxpayers earning income in excess of INR 50 million, the effective tax rate would be 42.74%. So this is interesting because India is moving towards a lower corporate tax rate regime, and whereas the individual tax rates are going up. So there is slightly a discrepancy whereby corporates are paying lower tax than the individual. One may argue that globally as well, in many countries like UK, Denmark, the tax rate for individual is higher. But only argument from our side on that is that the social security systems in those countries are robust, and hence the tax rate or the effective tax rate in those countries cannot be compared with India as of now. One incentive given is in order to free up the liquidity for individuals withdrawing from National Pension Fund. Earlier, 40% of the withdrawal amount was exempt when you withdraw from NPS. However, now that limit has been increased to 60%. So your 60% of the withdrawal would not be taxed. In order to promote e-vehicles, an additional deduction of interest up to INR 1.5 lakh on loan taken by an individual for purchasing electric vehicle has been proposed. The condition is that loan has to be sanctioned by any financial institution or NBFC between 1st April 2019 to 31st March 2023, and a person should not be owning any other electric vehicle as on the date of availing this loan. Certain measures were announced for widening the tax base by the finance minister. One important change or very relevant change was encouraging people to file tax returns in India. So for categories other than company, so for company already all companies are required to file a tax return in India. However, for taxpayers other than company, they would be compulsorily required to file a tax return in India, even if their income does not exceed INR 2,50,000 rupees, which is the exemption limit provided. If they deposit INR 10 million in one or more of their current bank accounts. So if as an individual, while I am not reporting my income stating that it is below 250,000 rupees, but I will have to file a return if I am depositing INR 10 million or more in a bank account, or I am spending more than INR 2 lakhs for travel to any foreign country, or my electricity consumption bills are more than INR 1 lakh. So this actually is a welcome move, because this would bring into tax net people who are not legitimately offering income to tax, at the same time are having huge expenditures being made. One more step introduced to widen the tax base is to introduce a withholding tax of 5% on payments made to contractors and professionals for payment exceeding INR 5 million by individual and HUF. So earlier what was happening, individual and HUF, if they are availing any services for their personal use and they are not liable to tax audit, they were not liable to withhold any taxes on contractual payments or professional payments. However, now they would be obligated to make a withholding tax on those payments if it exceeds INR 5 million. And in order to provide for compliances, they have said that they would not be required to obtain a TAN number, that is a tax account deduction number, but they would be required to use their PAN to file the withholding tax return or the challan which may be prescribed. One more important change was that in many real estate deals whereby any immovable property was purchased, typically the consideration for the sale of property and for use of other amenities were segregated by the builders, and taxes of 1% were only withheld on the sale of property price. However, now they have widened the definition of what is construed as consideration for acquisition of immovable property. Now even any separate agreement or any separate charges paid for use of amenities or for any other charges which the builder may charge would also be considered as consideration for acquisition of immovable property, and withholding tax of 1% would apply. There was one more controversy as to if any rupee gift made by a Indian resident to a non-resident, whether it is taxable in the hands of non-resident or not. Typically, the non-resident taxpayer were taking an argument that this income would not be taxed in India, as this income does not deem to accrue or arise in India, neither it is received or deemed to be received in India. However, it has been categorically now mentioned that gift tax would apply to transfer of money or property situated in India by a resident to a non-resident. Further, in order to encourage reporting and also help the government in providing pre-filed tax returns, they have made reporting of SFT applicable without any limit. So earlier, any person or specified taxpayer was liable to file a SFT form only if the transaction value exceeded INR 50,000. However, that limit has been done away with, and also penalty has been prescribed to ensure that there are correct filings done by the responsible persons. And in order to encourage cashless economy or move toward digital payments, government has introduced certain provisions which would curb the usage of cash in the system. So they have introduced for a withholding tax of 2% on cash withdrawals exceeding INR 10 million. So any banker has to ensure that if any withdrawal by a business is exceeds INR 10 million, then they would be liable to withhold taxes at the rate of 2%. Certain specific exemptions have been granted to government, post office, banking companies, white label, ATM operators, because the business nature is such that they may need to withdraw a huge amount of cash. Further, all businesses having turnover exceeding INR 500 million would be mandatorily required to provide facility for accepting payment through prescribed electronic modes. So any corporation having turnover of higher than 50 crores would be obliged to provide payments through any electronic modes to the customers, and any non-compliance to this condition would lead to a penalty of INR 5,000 for each day till the time this failure continues. And also they cannot levy any additional charges on the customer because they have been exempted for those charges by the banks and other system provider, so that there are no ultimate charges given to the customers. Certain tax incentives has also been proposed in the budget. So one of the important measures or tax incentives provided is to International Financial Service Center. So this IFC were introduced few years back by the government. However, the investment in International Financial Service Center had not picked up because the same were not so popular. In order to boost the investment in this financial service centers, government has now proposed that capital gains tax exemption should be extended to category 3 AIF. So category 3 AIF can set up in International Finance Service Center, and once it is set up there, subject to certain conditions, there would be no capital gains payable by the AIF category 3 funds. Also, earlier the benefit was available for derivative transaction. Now they have provided exemption even for equity and other transactions. So this will encourage more companies to even list on exchanges, list under the International Financial Service Center. Also, interest on money borrowed from non-resident by unit of International Financial Service Center is now exempted from tax. TDD provisions have been rationalized. TDD provisions have been relaxed, so now no DDT would be applicable on the accumulated profit. So earlier, DDT was not applicable only if the distribution was made from the current profits. Now they have extended to say that even if you distribute the dividends from your accumulated profits, we will not levy dividend distribution tax. It has been also offered to mutual funds to relocate to International Financial Service Center because they have given a no tax on income distribution by mutual funds after 1st September 2019. And other relaxation is on offshore funds. Earlier, as we were aware, that Section 9A was introduced to see when an offshore fund would constitute a business connection in India if it has a fund manager in India. So there were certain conditions which were slightly problematic for the funds to meet. Now certain relaxation has been provided to those conditions. So the fund was required to invest a corpus of 1 billion. The time limit for making those investments has now been relaxed. So earlier the condition was that they were liable to invest this 1 billion by the end of financial year. So for example, if the fund was set up in February, they were liable to invest this 1 billion by March. So they should get only a funnel of 30 days. Now they have said that it should be either end of the financial year or 6 months from the setup of the fund, whichever is later. So now if I have set up a fund in February, I will get time till June to actually invest that money and not immediately within 1 month. Earlier they said that in order to determine that the fund manager is independent of the fund, he should be remunerated at an arm's length price. However, how the arm's length price would be calculated was not defined, and there were certain ambiguity around the same. So now they have said that instead of doing an arm's length pricing, what we will do is we will prescribe an amount. So for example, if they provide 10 million INR and they say that about 10 million INR if the fund manager is paid, then it would be considered as payment of arm's length, and there should not be any additional condition which would be required to be satisfied. For given the recent non-banking financial services or the non-banking financial company crisis, it was a need of the hour to give some incentive to them because they have been struggling recently. So now regulated NBFC have been given a status which is in par to scheduled bank cooperative banks. Any interest income on debts which are classified as bad or doubtful debts would be taxed only on the receipt basis. Earlier, what was happening that due to the accounting methods followed by these NBFCs, they were recognizing this interest even on some bad and doubtful debts, and those interests were getting taxed while the receipt of those interests or even the principal was not a certainty. So now the relief has been given as to taxing them only on receipt basis, and as a corresponding amendment, these payments to the payer of the interest would be allowed only on payment basis. So while this appears to be a very natural amendment, but the impact of this amendment is that 43B scope, which is allowability of expenses on payment basis, is widened. So any person actually accruing interest payable, even though those debts are not a bad debt or classified as bad debt, would also not get a deduction for this payment of interest to an NBFC until and unless they have made the payment. So this could be an unintended error which may crop up for the genuine taxpayers as well. In order to boost the affordable housing scheme, they have provided for an additional interest deduction of INR 1.5 lakh for home buyer. However, there are certain conditions like loan should be sanctioned between April 1, 2019 to 31st March 2020. Stamp duty value of the property should not exceed INR 4.5 million, and taxpayers should not own any other house. For startup, there were certain specific measures introduced in this budget. One very important being that condition for carry forward of losses on change of shareholding has been liberalized. So now startup need not necessarily hold the entire share. That 50% condition has been relaxed to state that if the promoters are continuing to hold the shares, then they would be allowed to carry forward the loss and claim a set off. Capital gain exemption to investment in eligible startup has been further liberalized. The sunset date has been extended from 31st March 2021 instead of 2019. Minimum shareholding in startup relaxed to 25% from 50%. Also, a lot of incentive has been given for AIFs and others to invest in a startup. So issue of share below fair market value was earlier taxed in the hands of the investor, but now if a AIF3 involves invest in a startup, then this exemption has been provided to them. Coming to other measures, a few important other measures were corporate tax rate reduced to 25% for companies having turnover up to INR 4 billion. So earlier it was 2.5 billion, now it has been extended to 4 billion. The government believes that this would cover more than 99% of the population, and very less number of taxpayers would now be under the higher tax bracket of 30%. Faceless assessment, as we discussed, to be implemented from this year onwards. PAN and Aadhaar interchangeability provided. So wherever a taxpayer is required to quote a PAN and he does not have a PAN, then he can quote Aadhaar for doing the compliances or for submission of any relevant documents. Online process has been prescribed for lower or nil withholding tax order for non-resident payments. So whenever a resident has to make a payment to a non-resident and they are not sure as to what would be the withholding tax rate applicable on such payments, at that point in time, he can make an application to the tax officer for determining the tax rate. So earlier this was an entirely a manual process. Now the process has been shifted to an online process. One hidden surprise which came in the budget was buyback tax on listed companies. So what government has done is they have now, earlier buyback tax of 23% approximately was applicable only for unlisted companies doing buyback of shares. Government feels that there are many listed companies as well who are avoiding payment of dividend and instead going under the buyback route. And hence, in order to plug that tax avoidance or tax arbitrage, government has introduced taxation buyback tax on listed companies. But it is interesting to note that this may have some tax leakage on the part of the company, because what happens when a company does a buyback, what deduction it gets is of the issue price. So for example, say an ABC company buys back the share at 1,000 rupees and the issue price of the share is 10 rupees, then the tax is payable on 1,000 minus 10, that is on 990 rupees the tax is payable, without considering what would be the purchase price of the shareholders, because this tax is being paid by the company. So this may result in substantial higher taxes, as the company would pay tax on 990 rupees, whereas the actual gain in the hands of the shareholder may be anywhere between 990 rupees to 0 rupees, because the shareholder could have bought this bought these shares at any price. And also one smart amendment or recommendation which the government made was increasing the public shareholding in listed equity from 25% to 35%. So what does this mean? So when public shareholding, so there are many MNC companies where shareholding is up to 75%, and they may not want to dilute their shareholdings. So in such a case, they may look at delisting from the stock markets. And when they look at delisting, they will have to make an open offer, which will result in a buyback offer. And once they do a buyback, this buyback tax would trigger. So it's a smart move, we can say, whereby there could be huge tax collection if anybody wants to go for delisting. Otherwise, they may have to go ahead and dilute the stake. Carry forward losses on change of shareholding has been liberalized for companies which are under NCLT, because obviously there would be certain shareholding changes which may happen in those cases, and then hence these conditions have been relaxed. Demerger condition have also been relaxed for companies where Ind AS is applicable. So one of the important condition for demerger was that you need to record post demerger, the demerged entity was liable to record the assets and liability which it has received from the demerged company. The resulting company was liable to record those assets and liability at the same price which were appearing in the books of the demerged company. However, if the resultant company, if Ind AS provisions are applicable, it was not allowed to record at the same price, but it will have to follow the Ind AS. So in order to rectify this anomaly, they have said that it would be the demerger benefit would be available even to the companies where they follow the Ind AS as a resultant company. Certain important clarifications were provided on the transfer pricing side. So earlier what was happening, that APA, as we are aware, is applicable for 5 years, and also it can be rolled back for 4 years. In these cases, what was happening, that after the rollback or the process of APA is completed, the taxpayer was filing a modified return, and the language provided under the law was that assessing officer has the power to reassess or recompute the income in case of a modified return of income. So because of this language, even the modified return which was in line with the APA sign was reassessed or re-scrutinized by the tax officer. Now they have clarified that the tax officer can reassess or recompute income only keeping in mind what the APA has been signed. So he can only verify whether the modified return filed by the taxpayer is in line with the APA signed, and it cannot go on any other aspects which are already examined. Important or a very important change is on the secondary adjustment. So earlier what was happening, a couple of years back, change on secondary adjustment or amendment on secondary adjustment was made, whereby an Indian company, if there is any adjustment on account of transfer pricing, say for example an Indian company is a cost plus 15 company, cost plus 15 percentage company, and the tax officer or the transfer pricing officer has made an adjustment whereby they have increased the cost plus margin from 15 to 20%. So the 5% is the additions made by the transfer pricing officer. And in order to buy peace with the tax department, the taxpayer does not go for any further litigation. Then that 5%, so assuming that 5% results in 10 million, that 10 million amount was liable to be recovered from the parent company or the group company by the taxpayer. And in case they don't recover that 10 million, then it was treated as a loan and interest would have to be charged on that. And this was creating a lot of practical difficulties for the taxpayer. So now they have proposed that as an alternative, instead of recording it as a getting back that money, pay an additional tax of 18% plus surcharge on that amount, and then there would be no further requirement of getting back the money. So this is a prevalent practice in developed countries where secondary adjustment provisions are there. This is akin to a dividend kind of a tax, whereby dividend distribution kind of a tax, whereby if you are not able to get back the money, you pay a one-time tax and close the matter there and then. Also, there was certain confusion on what would be the CBCR reporting year for the parent company. So they have clarified that it would be the same year which the parent entity is following in the home country. So with this, I come to the end on the direct tax changes. Now I will hand over to Rebecca to take you through the indirect tax proposal in the budget. Thank you.
Thank you, Nishit, for summarizing and decoding those numerous DT proposals for us. It really clarifies clarifies a lot of confusions for us. Before we move on to the IDT budget proposals, ladies and gentlemen, I would like to set some background to the IDT proposals. I'm sure most of you must be aware, but just to align everybody hearing us today, Nirmala Sitharaman, the finance minister, she is the first full-time woman finance minister and the second lady to present a finance budget after Indira Gandhi. Acting by her first time innovation, she also introduced or brought the budget into the parliament in a traditional bahi khata and not the suitcase like the British colonial times. Why is this important for her IDT proposals? Just like her innovative styles, this time's IDT proposals have also been very innovative and unlike its predecessor's budget. This time's IDT budget is aligned with BJP's manifesto on three folds. First, the reduced tax rate proposals. Second, the higher tax collections. And third, to ensure greater compliance. These three proposals from the BJP manifesto could also be linked with the economic survey of 2018-19, in which it was indicated that taking a cue from the behavioral economics, the government wants to change the mindset of people from tax evasion to tax compliance. Hence, IDT proposals this time are heavily focused on litigation and giving the assessees or taxpayers a chance to wipe off the old sins. Moving on to the customs proposals. There have been a number of custom rate changes. A few of them have been outlined here for ease in understanding. Exemptions withdrawn are from electronic items and paper products. Exemptions have been added to the defense equipment, capital goods for manufacture of electronic goods, specifically e-vehicles, BCD exemption on specified parts of line and telephone handset, inputs for artificial kidney and disposable sterilized dialyzers and fuels for nuclear power plants. There has also been an increase in rates. This is more to act as a deterrent to import these products. 5% basic customs duty has been imposed on books. Basic customs duty on tobacco and crude oil has been increased. Gold, silver, platinum and other precious metals have seen a rise in customs duty from 10% to 12.5%. Auto parts, synthetic rubber, optical fiber, CCTV camera, IP camera, digital and network cameras have also seen a rise in customs duty. Petroleum products and diesel products have seen a rise of special additional excise duty by 1 rupee each. Effective rate of basic customs duty has also been increased on petroleum crude. If we bifurcate sector-wise, you will see precious metals, inputs for construction, electronics and automobiles are those key sectors that have suffered or have been added to the additional duty chart. What have been the other key proposals in the customs law? Customs law has increased the scope to arrest or the power of the customs officer to arrest. This is by way of deletion of the terminology, any person located in India or within customs Indian customs water. So the scope has been widened to include anybody who has conducted a fraud under Indian customs law. There has been arrest and penalty provisions introduced for fraud in relation to duty drawback and foreign trade policy incentives. GST proposals. Anti-profiteering as a story was dying down. This budget has reintroduced the vibe in anti-profiteering by amending the provision and adding a penalty clause of 10% of amount profiteered. Now, what is amount profiteered has been defined to mean any amount that you have not passed on to your customer because of reduction in rate of tax or benefit of ITC that you have received due to implementation of GST. If by way of an anti-profiteering one receives an order, the government has also given a provision wherein within 30 days if this amount is deposited, there would be no penalty or this 10% penalty would not be applicable. So to set light on this anti-profiteering, recently there was a press release issued by the government which said that out of the entire anti-profiteering orders or investigations that were started, 67 orders were issued, and out of 67 orders, 26 cases were confirmed with a liability of 600 crores. Now, if this provision is made effective, we are talking about 60 crores straight into the government kitty by way of penalty. And this is just, ladies and gentlemen, for 26 confirmed cases across pan-India. So we can imagine the quantum or effect of this provision or amendment. Powers to the state has been increased. Earlier, there was no power for the state to amend or extend the date of annual returns and audit. This amendment has been brought in by way of a proviso. Also, at the request of the state government and on recommendation of council, the enhancement of aggregate turnover from 2 million to 4 million has been proposed in this union budget. Clarity on the aggregate turnover has also been brought in, wherein if there is an interest on interest earning or any other consideration on deposits, loans or advances, this has been excluded from the calculation of aggregate turnover. What is the impact of this? In simple terms, if you are an entity which has earned say 5 crores of interest income, but at the same time your taxable turnover which is liable to GST was say 1 crore. In such scenario, your calculation of applicability of audit will see a big skew because till date we were not sure of whether to include the 5 crore interest earnings into the aggregate turnover calculation. There were divided views on this topic. The second point on aggregate turnover is that when a person is trying to register, say he registers today, that is on the 5th of July. His turnover earnings from 1st April to 5th July will not be counted for the calculation of aggregate turnover. That means the turnover for deciding your audit limits or your composition limits, all these will see a change because of this proviso. The other proposals are on service tax exemption. The service tax exemption for long-term lease of land by government has been removed for the period 1st October 2013 to 30th June 2017. Ladies and gentlemen, here I would like to add that this exemption or this removal of service tax is specifically for infrastructure in relation to financial services for the government and by the government. Any amount that has been recovered in relation to such long-term lease will be refunded as per the procedure prescribed. Transfer of balance, transfer of tax, interest, penalty, fee or any other amount available in electronic cash ledger of CGST can now be transferred to the electronic cash ledger of IGST, SGST or UTGST. Thereby to say, if I have paid tax under a wrong head, instead of paying it under the right head or repaying and reclaiming such refund, the government will now try to adjust this internally in the cash ledger. Important change that has aligned itself with the income tax proposal is on Aadhaar linkage. The Aadhaar has been introduced as a customs verification in GST registration document. This is very critical or pivotal for those companies who are having foreign directors on board, because the provision clearly states that either you should have an Aadhaar or a valid identification proof. In absence of both, your GST registration would not be considered valid or the customs verification would have to be conducted in them. The scope of payment of interest on delayed payments has been limited to only the portion that is payable through electronic cash ledger. In other words, if the amount is payable through electronic credit ledger, you may not see a interest implication. However, this is limited to only tax payments under section 39. That means your return or self-assessment payments, and not applicable to assessments instituted by the government. Moving on to the litigation roadmap. All of us have been a witness to the number of advance rulings that have been issued by the GST authorities, advance ruling authorities. Also, there have been varied views in various states. Given this, to streamline and align the advance ruling decisions, a national appellate authority for advance ruling has been set up. This will consist of a 3-member bench, one being president and 2 technical members, one from the central and second from the representing the state. This will help align a lot of positions at pan-India level as well as at entity level which have multiple state presence. Litigation dispute resolution roadmap. The litigation dispute resolution roadmap is an amnesty scheme that has been introduced by the government. Here, an important focus area would be that while a number of deductions or relief has been provided by the government, there are certain assessees or taxpayers who will not be entitled to opt for this amnesty scheme. Who are those persons who will not be entitled to opt for this amnesty scheme? Are people who have filed an appeal before the appellate and the final hearing of this appeal has been done before 30th June 2019. Any convicts under the IDT laws. For taxpayers who an SCN has been issued and final hearing has been taking place before 30th June 2019. SCN issued for erroneous refund or for refund. Audit, investigation, inquiry initiated before 30th June and amount not quantified up to 30th June. Those taxpayers who have voluntarily gone forward and disclosed their liabilities. Applications that are pending before Settlement Commission and declarations with respect to Schedule 4 of Central Excise Act 1944. What we would like to highlight here is, other than these assessees, all taxpayers who are opting for this scheme, any appeal pending at any forum or judicial tribunal will be deemed withdrawn. This scheme allows the assessee to pay their tax liabilities with certain relief, which I will just outline in a moment's time. But before we outline that, any tax liability paid under this scheme will not grant you immunity for the past as well as future periods. So the immunity with respect to additional interest, penalties will be limited to only the period during which you have gone for dispute resolution. To give you a simple example, if I have opted for a dispute resolution for the tax dues for the period of January 2017 to July 2017 or June 2017, In that scenario, any disputes that are prior to January 2017 will not have immunity from the decisions or orders given under this legacy dispute resolution scheme. What are the benefits provided under this legacy dispute resolution scheme? If I have received an SCN, the first case, let's take it case-wise. There are 4 cases and 2 scenarios depending on the threshold of your tax dues. The first case is when SCN for tax or appeals arising out of such notice is less than or equal to 50 lakhs. In such scenario, I will have a relief of 70% of my tax due. If the amount is more than 50 lakhs, I will have a relief of 50% of my tax due. Likewise, where the SCN is issued only for late fee or penalty and the tax has already been deposited, the late fee or penalty will be waived off entirely. If there are amounts in arrears or amount has been showed as payable in the returns but has not been deposited by the taxpayer, in such scenario, the relief is up to 60% for amount of tax due less than or equal to 50 lakhs and up to 40% for where the amount is more than 50 lakhs. Tax dues are related to the investigation, inquiry, audit against the taxpayer. In such scenario, again, like your first scenario, a 70% relief for up to 50 lakhs of tax liability or tax due amount and a 50% relief for more than 50 lakhs of tax due. Here, ladies and gentlemen, it would be very important to note that the entire scheme that has been brought out in the finance bill does not mention the word interest. But this terms interest and penalty has been used as a memorandum to the has been used in the memorandum to the budget speech as well as the bill. So this is some anomaly that could see a clarification in coming days. All the proposals that other than the rate changes are yet to be implemented. They will be implemented once the finance bill receives assent by the president. That's all on the indirect tax front. Thank you for listening and being a patient audience.
Thank you for the presentation, Rebecca and Nishit. We now invite all of you to type your questions in the chat box for our speakers to answer.
One of the questions asked by our audience is in relation to National Appellate Tribunal for Advanced Rulings, wherein the specific question was whether it will be only in relating to conflicting advance rulings or any other appeals that are pending in absence of a GST tribunal that has not been yet set up. Dear member would like to clarify that this setup is only with respect to advance ruling. This does not talk about the GST tribunal setup for other litigation in relation to GST law. We will just read out the second question in a moment.
Second question is on applicability of 25% tax rate to the companies from which year. So the bill clarifies that it is for the turnover from the financial year 17-18. So any company having turnover below INR 400 crores would be eligible to claim the 25% rate. And one more question is on TDS by individuals on compliances. So currently, no specified form or whether they would be required to file any quarterly tax returns has been prescribed as such. But it may be similar to what amendment was done for 194I, that is the rent payments, whereby one single form cum challan was prescribed and that was being used by the individual taxpayer. So we hope it's similar, because if it is quarterly tax return, then it could be a compliance burden on individuals.
Another question from our member is on the penalties for fraud in relation to duty scripts and duty drawbacks. The question is, what is the maximum penalty that can be levied? As per the budget proposals, penalty up to the face value of instruments shall be levied on such fraud or default cases.
Thank you, Rebecca and Nishit, for taking out the time to share your valuable insights with us. We hope that the insights shared by our speakers have been useful for all our listeners. Thank you once again, everyone, for joining in.